So, Jack, real short-term tactical stuff here. I did see this fade in the indexes here. We're at highs, for the major indexes. The atmospheric conditions seem pretty favorable here. What's your read on what we're seeing?
Yeah, I mean, I think right now it's a pretty quiet week from a data perspective. There aren't a lot of policy headlines hitting us, at least not expected to this week. All markets can really focus in on is this earnings season, and the earnings season's been pretty darn good. I think analysts really lowballed it coming in here. They thought that the macro economy would be in worse shape than we are right now, or at least they thought that some of those implications would hit us a little bit quicker than they have. I think they also really underestimated just how good corporate America is at protecting margins. And so for right now, right, I mean, the earnings story is good. The guidance has been encouraging. I also think it's important, though, Mike, to take a step back here and realize that, yes, we're back at all-time highs. We've reached 6,300. We're probably going to close the day north of that milestone, and that is a huge accomplishment. But how do we get here? I mean, we are looking at forward price to earnings ratio on the S&P north of where it was before the sell-off, 22 times and plus. This is a market that's working well right now, but it's also priced for perfection.
And how do you then approach it? In other words, what's the takeaway from, hey, this is a fully valued market. It really doesn't owe us very much from here on out. On the other hand, one of the hardest things to do is to kind of continue to give the benefit of the doubt to a trending market.
Yeah, I mean, this rally, the one that happened sort of since those April lows, it has been driven overwhelmingly by multiple expansion, so not encouraging. On the other hand, though, when you compare it to the previous rally, the rally that occurred in the aftermath of those October 22 lows, the breadth of this recovery has been a whole lot more impressive. The Magnificent Seven accounting for 60% of all the returns in 23, 60% of all the returns in 24. It's about half of that from a contribution perspective so far this year. We're seeing that broadening out in price performance. We're seeing a broadening out in earnings growth, which is helping to support that. Very, very difficult right now to figure out, is this a growth market, value market? Is it tech versus financials or energy versus healthcare? This, to us, is a bottoms-up security selection market. This is all about active management, being able to weed out those winners and losers.
If I look at things like, and a lot of the broad market analysts who want to sort of discern the message of the market say, okay, cyclicals have consistently been leading defensive sectors of this market. Credit spreads are compressed. Gold's back above 3,400. The dollar has been on its back foot, although bouncing a little bit recently. All of that suggests loose financial conditions, plentiful liquidity, and generally favorable macro. Is that an environment in which we should be screaming for the Fed to cut rates?
So, I mean, I think, frankly, the answer is no. I mean, this economy very clearly does not need lower interest rates right now. At the same time, though, Mike, I don't think lower interest rates would really hurt this economy.
Right.
I mean, my kind of crackpot take on a lot of this stuff is the Fed has a lot less control over the economy than it thinks it does. It's got a boatload of control over asset prices. And it makes a move on its balance sheet, on the short end of the curve, and it can dramatically alter values for stocks, bonds, real estate, I mean, crypto if we want to go down that road. But CPI, inflation, actual GDP growth, this is an economy that seems to be almost agnostic to rates, at least on the margin. So, I mean, the economy probably doesn't need lower rates, but why not?
Yeah.
Especially with how intense our borrowing costs are as a country.
Right. It seems as if, I guess another way to put it is we're at a moment where the Fed is just not going to be the swing factor necessarily to make or break what the economy does. Now, there's a counter to some of those points, which is, look, we have a housing market recession by many measures, and the consumer is hanging in there, but real spending levels seem like they're decelerating, and maybe even the labor market is kind of softened up.
Yeah, I mean, I think, I think on the housing side of things, we have to acknowledge that homes are unaffordable right now, and buying activity is dwindling. And yes, that is a function of where mortgage rates are right now. But the reason mortgage rates are punitive at the moment is because of where home prices are. And home prices are where they are right now because we are simply not building enough homes. And that's not something that's going to change on the margin anytime soon. And you know what? If you drop rates down and push, let's call it 30-year Treasury yields lower, benchmarking against mortgage rates, maybe you get a short-term windfall. Maybe all of a sudden homes become a little bit more affordable. But then all those people that buy their homes, they're going to hold on to those things for dear life as soon as rates go right back up, and you're right back to this initial problem. Yeah. So I don't think that's like the solution to all this. From a consumption perspective, that's a kind of messy story, Mike, honestly. I mean, when you look at this economy and you look at who's doing the spending, the top 20% of the earners in this country, they spend anywhere between 40 and 60% of all the bucks. And when that happens, they're getting tax cuts, stock prices back at all-time high,
and confidence is up.